Hi everyone! The new year has been beneficial for stocks so far. Wall Street is mostly trading in the green zone, notching weekly gains. Last week was no exception. The Nasdaq 100 logged the largest increase, gaining more than 3%. Traders are curious whether it is a trend reversal or another correction. The second scenario is also possible since the equity market has been in the bear's clothes for a long time. For almost the entire past year, the benchmark stock indices have been dropping, occasionally starting short-term corrections. Perhaps market participants decided to take advantage of the thin market and reap a profit from short-term trades. Fresh macro stats are also impact market sentiment. The PMI services index contracted significantly. Many investors perceived it as a signal of a further slowdown in inflation and a policy reversal by the Fed. Watch our video review till the end and find out more curious details. Leave your comment down below. Let's start. Last week was extremely busy and stressful. Traders were anticipating the inflation report. Consumer prices have been declining for the sixth month in a row as expected. Inflation peaked in June, reaching 9.1%. For this reason, more than 90% of traders believe that the Fed will undertake a small rate hike of 25 basis points in February. The new week is also quite eventful. There will be lots of crucial reports such as US retail sales, the US producer price index, several reports on the housing market, and earnings reports of several large companies. Apart from economic news, there might be political events. Analysts assume that in the coming days there could be a conflict between Democrats and Republicans. So now they are gearing up for their occasional fight over raising the US debt limit. The market sentiment will be mainly influenced by the economic reports. The Fed is closely watching fresh macro stats before making rate decisions. It may seem that the Fed is tracking inflation figures very carefully. If the situation improves, the central bank could stop tightening monetary policy. However, is this really so? Should we anticipate a steady rally on Wall Street? As usual, there are some nuances. For instance, corporate insiders, that is, employees of large companies, do not buy shares of their companies. Perhaps they have some inside information. For this reason, they do not follow the current trend. One should also pay attention to the labor market. Almost every day there is news about staff layoffs in companies of a different caliber. Besides, many analysts are worried about an impending recession. Jerome Powell has said many times that the economy might endure a protracted period of pain. The economy has been hurt markedly due to soaring inflation. It will take a lot of time to stabilize the economy. Speculators will hardly choose risky assets in times of market uncertainty. Naturally, they will try to lock in profits following some positive economic data. Investors have been doing it successfully in the first 2 weeks of the year. The main US stock indices closed in the black on Friday after investors digested fresh economic data and the earnings reports of large banks. As a reminder, the earnings season has just started. The Dow Jones closed the week with an increase of 0.3%, showing the best weekly performance since November. Over the week, the Dow gained 1.6%. On Monday, the US trading floors were closed. This week will be shortened because of the holidays. Therefore, there were no significant changes in sentiment at the start of the week. The stock indices were trading with a bearish bias as investors tried to figure out whether a recent jump was a rally or not. Some large companies published their revenue results. Many of them slashed their revenue forecasts. Several large banks reported mixed results. At the same time, JPMorgan Chase, Bank of America, and Citigroup surprised traders with upbeat reports. They said they stockpiled more rainy day funds to prepare for a possible recession. The S&P 500 index added 0.4% on Friday. Over the week, it climbed by 1.7%. As for the future prospects, the S&P could test levels above 4,000 this week. At the same time, there is a big risk of a 3% or 4% bounce of Monday levels. A dive to the range of 3,850–3,900 looks quite real. Markets are now gripped by fears that a recession may begin in the global economy this year. Analysts are mainly focused on the US economy. Its contraction began in 2022, according to the general definition of recession. However, according to NCP criteria, the economy has not slid into a recession yet. A survey conducted by Bank of America shows that traders are unwilling to take risks now. The risk indicator turned out to be even lower than the levels observed in the crisis of 2008. The situation looked more positive even in 2020 during the pandemic. Despite the slowdown, inflation remains significantly above the Fed's target level. The next Fed meeting will be held on January 31st and February 1st. Policymakers are sure to make statements about future plans for monetary policy. Traders may get to know who prevails now, hawks or doves. Besides, the size of a rate increase may also serve as a signal. If the regulator hikes the rate by 25 basis points, it may indicate a shift to a more dovish stance. Nearly 17 of the 19 policymakers remain adamant when it comes to further tightening. They assume that interest rates will be raised above 5% in 2023. None of them expects a slowdown in monetary tightening this year. Only traders are mulling over this possibility. Meanwhile, the earnings season for the fourth quarter may become a test for risk appetite. Positive revenue results may push the S&P 500 index to 4,140. This is quite a modest increase, only about 4% of the current levels. At the same time, downside risks remain high. If the economy slips into recession, a pullback of 15–20% may take place. Last week, the Nasdaq 100 recovered considerably. It notched the longest winning streak since 2021. On Friday, it added 0.7%, gaining a whopping 3.1% over the week. Such a rapid rise was associated with the publication of upbeat inflation data. The Fed pays great attention to the CPI when making policy monetary decisions. The Nasdaq is the most sensitive to the Fed's decisions. A strong jump in the Nasdaq index made investors believe in a trend reversal. Did it really happen? It's too early to talk about it now. We need more signals. We can say for sure that the index managed to find a strong support level of 10,700 in October and December last year. Notably, the index kicked off a rally at these levels in September 2020. Thus, buyers managed to protect pivot levels. Of course, this is a good sign, but it is not enough to start a new upward cycle. The target level is now located at 12,000. Not far from this level, there was a reversal in December. This is why it is the most important trend line. The pivot level of the weekly charts is seen at 11,500. Long-term buyers showed more energy at this level back in 2018 and 20. They bought on the lag lines just below this level in the period from October to December 22. However, in the last weeks of the year, the bulls lost momentum. The first weeks of the year look promising. However, everything is changing rapidly in markets as there is no stability and confidence in the future. As for the earnings season, many banks announced quarterly profit results. They are expected to fall for the first time since the third quarter of 2020. Meanwhile, the shares advanced by an average 2.5%. Investors were mainly interested in the revenue results of JPMorgan. They were pinning their hopes on high profits. The bank reported optimistic results. Its revenue amounted to $11 billion, or 5.9%, significantly exceeding forecasts. However, senior officials of the largest U.S. bank shared their concerns. CEO Jamie Dimon said on a conference call that there was more competition for deposits as higher rates were causing customers to migrate to investments and other cash alternatives, meaning the bank was going to have to change saving rates. In addition, it is unclear what to expect from the headwinds caused by geopolitical tensions and an unprecedented increase in Fed interest rates. The bank noted a moderate deterioration in its macroeconomic outlook, reflecting a mild recession in the central case. JPMorgan Chief Financial Officer Jeremy Burnham said one of the necessary conditions for people to deal is getting comfortable with valuations, which fell last year. It could help in 23 despite a weak economic outlook. In general, the bank is increasing its revenue and continues to hire employees, unlike other financial institutions. That's all for now. Subscribe to our channel and stay up to date with the latest market news. See you!